Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. How's it going today? I hope you're having a great day. This is our FinTips series where we just do quick videos, teach you something new. It could be retirement-based, could be personal finance-based, whatever we can do to help you here. A lot of times it's just an update on what's going on. Today we're going to talk about the ETFs that have been most actively traded over the last 30 days and try to give you some insight as to why. We're financial advisors here, and we just try to help our customers. Every week we do a class, and we try to teach you something new in greater detail than what we can do here publicly. And so I'm going to dive in. If you're interested, let me know what you think, and let's see what happens here. We're going to use actually the dojo, which is a sort of a private little portal that we have for our customers where they see everything just like I do here. And also they can go back and watch our recent classes. We post every single class on here. Some of them are very advanced. Some of them are very basic. And some of them are just sort of how to navigate your account, see what's going on there. So if you work with us here at Jazz Wealth, you're always getting educated. We're really, really big on education. I know you can't make every class live, but at least you know that I'm going to be here, someone's going to be here every Thursday night trying to help you get a little bit better with your dough. Well, where's your dough going right now? Are you invested in index funds? Are you with a financial advisor or a portfolio manager that's doing well for you? Is he doing poorly? How are things going, right? We want to take a look at where the money's moving here. And so we're going to go over these most active ETFs. The first one you see on the screen is the SPY. Not only is it currently the most active ETF out there, meaning money flowing in and out, shares trading hands, it's also the original ETF. It's the very first ETF that ever existed. It's an index fund. So a lot of people get that confused. They say, well, index fund must mean mutual fund. No, not these days. It could mean mutual fund. It could mean ETF. So this is an index fund directly related to the S&P 500. SPY is the symbol. And it's by far the most popular out there, and volume proves it, really. There are others you can choose, but this one's the most active and usually is the most active. There's a company called First Bridge that puts together this data, and they send it out once a month, typically just after halfway through the month to give you an update. So over the last 30 days, the SPY has averaged a daily volume of $68.25 million. Each day, 68.25 million has averaged back and forth, buyers and sellers trading hands there. Now, that's actually lower. So even though this is the most active one, it has actually lost $8.3 billion in fund flows over the last 12 months. Why is that? Why are less people participating in the SPY? It's very simple. It's underperforming. You go, well, that's crazy, Dustin. Like, how could it be underperforming? I see, look at it, it's almost up 20% this year. We hit new highs. Everything's exciting. What's the deal? Well, we're looking back over the last 12 months. Now, if you're one of our customers and you've been with me since before January, you could choose year to date on your portfolio. You go into your account, you choose year to date, and you're going to see, if you're invested aggressively, you're going to see that you're beating the SPY. You're beating the S&P 500. And that's not like to toot our own horns or anything. That's by design. You can beat the S&P 500 over the long term. I know a lot of people think you can't, but the easy way for me to explain this is the S&P 500 is a man-made index. Why couldn't someone create another man-made index that they call their own index or a fund that beats the market in the long term? Speed and volatility. I teach my customers this all the time, and we prove it to them by actually showing them this happens. So here's what's happening. The S&P 500 or the SPY is the most active, but if we go and we look back here over the last year or so, not much has happened. Pick any random point and say, I started investing here, then go to now, and you have a small gain. Pick a point down here. Go to now, you got a small gain. Unless you invested in December and got really excited, you have basically a small gain, right? So a lot of people look at their 401k. I get calls like this all the time. People go, Dustin, I want to move to you because my company sucks. The people that I work with, they suck. And I ask them, well, when did you start investing? And they say, well, I started investing last October. Or I started investing last August. I haven't seen any growth. It's been almost a year. And I go, well, look, if you started investing in August, the markets fell rather hard. Congratulations for not selling, but they just recovered and came back here. So if you have growth of 5% over the last year or something, pretty much so does everybody else that started on the same day you did, so it's not that bad. Here's the problem. If you're a fund manager, portfolio manager, a hedge fund manager, mutual fund manager, you got to go put your money to work. There are other mutual funds that are competing for your business, right? and also you got to keep your job. So what they have to do is they have to move money elsewhere. REITs, utilities, consumer staples, healthcare now even. Those are better performing areas of the market. Doesn't mean you move from the SPY or from the index over to a specific sector. It means that you raise the allocation to that sector. So for example, if it were utilities, if you're in the S&P 500 divided as it is, you might choose to move a little money from somewhere into utilities, right? So you're just balancing the scales a little bit. It's a pretty poor way to explain it. I'm sorry about that. But the bottom line is money is moving out of the SPY and moving into other areas of the market so that they can show that alpha or show that growth to their customers. So that's the most active one there. Over the last 12 months, or 1 month, sorry, $68.25 million has traded hands inside of that. That's down by about 22%. So a lot less volume going back and forth in the SPY. People are just moving elsewhere there. So that's that one. All right, second, this one might be kind of weird for you, the EEM. This is Emerging Markets ETF. What's an emerging market? An emerging market is a country, or a group of countries in this case, that aren't really developed countries like the U.S. Maybe their currency is more volatile. Maybe their banking system's not as shored up. They haven't been through the sort of back and forth as a growing country. So there's more volatility there. They're growing, but they're not quite massive yet. Well, there's a lot of them. I think there's 24. It depends on what index you look at. MSCI, by the way, I think is like 24. JP Morgan has like 22, something like that in there. Different countries. And so why is money going into this? $67 million has traded hand on average each day. What's going on? Tariffs. So short and simple. It's tariffs. What's happening is Trump put tariffs on China. There are companies that are saying, well, we don't know how this is going to work. We should probably move our manufacturing somewhere else out of China. And also, it's getting more expensive to manufacture in China because they're becoming developed. In my opinion, they are a developed country. They are no longer an emerging market. And so everybody that works there now is demanding higher wages. People are becoming more into the middle class and even upper middle class. And so these people won't work as cheap as they used to back in the day. So add tariffs onto that, and you have manufacturers saying, okay, going to move the money out of China, or manufacturing out of China, and we're going to go to Thailand, Taiwan, Bangladesh, right? And so what people are doing here is they're investing in the EEM because they're saying, all right, if that continues to happen, we know that Bangladesh will profit from the textile manufacturing. That's really where all that's going right now. We know that Taiwan is sort of trying to get and is getting the technology side of manufacturing. And so these emerging markets, emerging countries, these are people that are willing to work for less. They will eventually grow, but for right now, there's that discounted thing, which means more profit for the companies that move over there, better margins, of course, and everything. And so if you want to participate in that, the most popular way is the EEM. The only downside? China is still considered an emerging market. So China is in this as well. Some of the top holdings in this fund are Chinese companies. So little downside there, but anyways, EEM is number 2 as far as the most active over the last 30 days. Number 3, and usually in the 3 to 5, third to fifth place kind of range, is the XLF. This is a sector-based ETF, a sector index fund, if you will. I just call it a sector ETF. And think your big banks here. Think Bank of America, JP Morgan, Goldman Sachs, Berkshire Hathaway. These are all companies inside of the XLF. Your big, massive banking centers are in this space. Now, they've actually seen a lot of money come out of it as well. Over the last 30 days, they've averaged $40 million a day. You go, well, that's pretty impressive, Dustin. $40 million changing hands daily on this ETF between the buyers and sellers. But that's actually a lot lower. Typically, it's around $51 million is the average daily volume. So what's going on here? People moving money elsewhere. The XLF has underperformed. It's not an exciting sector right now. Yeah, there are people that think interest rates are going higher, banks will have greater profits, and therefore maybe I want to invest. It's doing better. But all in all, when you compare it to other areas of the market, like utilities, REITs, healthcare, consumer staples, things like that, there's an argument to be made for the active investor to go over here and invest over here. So the XLF struggling just a little bit there, but coming in third place. In fourth place, which usually this one's not near the top of the list, is the GDX. This is a gold mining ETF, which the word says it all. These are companies that mine for gold. period. Now, it's done well recently here, but the GDX is actually the first ETF on our list today that has positive fund flows going into this ETF over the last 12 months. $1.2 billion moving into the GDX. So average daily volumes, $38 million. That's about average over the last 3 months. It's a little bit low over the last 6 months. It's increasing rather sharply, though. Why? Gold. Have you seen gold? You could look at this ETF, GLD. This is the price of gold. It's done really, really well recently. The dollar falling. It's trying to break out of a range if you look at a longer chart here. And so because of that, the GDX has benefited. Think of it as like when oil is rising, oil companies do well. When gold is rising, gold companies, the people that go mine for gold, they do well also. There's also a lot of consolidation in this space right now. There's a lot of different companies that are saying, hey, we can't work as individuals anymore, so they're merging. There's a lot of great mergers going on in this space right now. Anyways, so gold miners, that's the next on your list there with positive fund flows overall. We won't do too many more of these. Let's look at the NASDAQ. This is the QQQ. Used to be 4 Qs, got too hard to say that. People would just call it the Qs, and still today we call it the Qs. So this is the way to invest in the NASDAQ. It's an index fund. So if you say, I'm an index fund person, but I don't like the S&P 500, or I want that greater exposure to tech and biotech and things like that, well, that would be your NASDAQ here, the QQQ. This has positive flows as well, meaning more money's coming in than going out, $2.2 billion to be exact, and you're seeing an increase over the last 30 days of money coming into tech. Why? Again, a lot of other places are underperforming. If you're a fund manager, if you're investing for high net worth people, right, you've got to go prove to them you can do better than a benchmark. And maybe the benchmark is the S&P, maybe it's something else you've decided. But this area has outperformed. I know lately it's been a little volatile, but basically it's outperformed. And so that one's next. And we'll just do one more here, Brazil. No, I'll do a couple more. You got Brazil doing well. $53 million coming in over the last 12 months, $30 million over the last 30 days. That's a pretty much average move there. If you follow what's going on in Brazil, you understand the people that want to buy that dip. I won't go into it in this video so much, but they got a lot going on over there, basically. So as Brazil falls, you see a lot more money coming in, and so got a little bit of a bounce going on there. Finally, we'll do oil. USO is the ticker symbol, the most popular way to play oil, ETF-wise anyways. And so USO has actually seen $29 million daily average trading hands there. And that's really high, actually. The average is about $24 million. Why is more money coming back into oil over the last 30 days? Well, look here in the dojo. You got the price of oil falling. When the price of oil falls, the retail public says, you know what? That's because Tesla's taken over. We're going to drive electric cars for the rest of our lives. That's not true. Remember ethanol? Remember when everybody said we're going to drive ethanol cars the rest of our lives? How'd that work? It didn't work. We can't all use the same power, right, for lack of a better word, to drive our cars. There has to be a good mix, right? Everybody knows that. But when oil falls, people go, well, electric cars are taking over. We don't need oil. What people forget is that basically everything you look at has oil in it. Anything plastic has oil in it. Everybody attributes it to cars, but in reality, we need oil for everything. I'm looking at my computer, the camera, the lens, the casing on the lens there, the housing on the lights there, the plastic on the monitors here. Everything has oil in it. Maybe not as much, but we need oil for all of that. And so because of that, when oil falls, those in the know, those that are managing that big money, those that are looking for those discounts, they come flying into this and say, it's a commodity that's not going anywhere in our lifetime. Buy the dips. That's what everybody's doing. So because of that, you don't have to take my opinion about it. You can just look at the fund flows and see, yep, people are looking at oil saying, I got to buy that, right? I'm buying that dip. So that's what you have there with the price of oil. Anyways, I know this was sort of a long one today. I hope you enjoyed it. Later today at 5 o'clock, we'll be doing the closing beat. Every day we do a live show to give you an update on the stock market, really just try to tell you what happened without all the fluff and commercials and things. So we'll be back for that, of course. If I helped you in some way, maybe you'll hit the subscribe button. I'm supposed to say that for some reason, and I appreciate it. We'll talk to you guys soon. See you at 5 o'clock today.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.